Hi, I'm Shawn Bragdon. I'm managing partner of BGA Insurance in Costa Mesa, California. I want to thank everyone for joining us on this webinar. And we'll keep the questions at the end. But the topic today is U.S. life insurance for foreign nationals. This has been a space that BGA Insurance has been very active in over the years, and just wanted to educate some people that if you're bumping into this space. So basically, why do foreign nationals invest in the U.S.? Well, the United States has highly developed, liquid, and efficient financial markets. The United States has a very strong corporate governance, and we have very large institutions that have been around for over hundreds of years, some of them, and we have potentials for much higher returns than if a foreign national is just keeping all their assets in one country. And of course, that leads to diversifying your risk. So higher returns, a lot of corporate governance, highly developed, liquid, and efficient markets are the primary reasons that you see a lot of foreign nationals coming out to the U.S. and investing. Another very important factor that I've seen is the fact that the U.S. is not a participant in CRS. And what is CRS? That's the Common Reporting Standard. Basically calls for an automatic exchange of financial account information between the countries that are members of this CRS compact. To date, there are slightly over 109 nations or countries that are part of this CRS compact. The United States is not one of them. And if you are a member of this compact, your privacy and your confidentiality on the assets that you own, they're not there. And so with the United States not being part of this, you can have privacy, you can invest in assets out here, and you know that that information is not going to be shared with other countries. And that's one of the reasons that you're seeing the U.S. is considered a hot new market and the go-to place to stash foreign wealth. Um, Often foreign nationals are coming out to the United States to buy real estate. And real estate in the United States is considered a safe, secure investment, an investment that you can count on getting, nice rental income, long-term appreciation. And owners of real estate in the United States have very strong private property rights, where they don't have as strong of rights in other countries. One of the issues with purchasing U.S. life insurance or U.S. Real estate for a foreign national is that exposes a foreign national to a U.S. estate tax. If you are a U.S. citizen or a permanent resident of the United States, you have an estate tax exclusion of $12,060,000, and this estate tax exclusion does go up with inflation. But if you are a non-resident alien, a non-citizen, your exclusion is only $60,000. So any U.S. tangible assets that you own, you're going to be subject to an estate tax on anything exceeding a $60,000 amount. Now, one way to get around that U.S. estate tax is to hire some attorney. You'll probably pay tens of thousands of dollars, and you would set up a series of trust and partnerships to own that real estate. This is what's referred to as layering. It is very complex. It's expensive to set up. And to tell you the truth, it's not very black and white in the tax code that this actually will exclude that real estate asset from estate taxes. So not necessarily the best solution, but it is out there. What I see as the best solution and the primary solution I see foreign nationals use to cover that U.S. estate tax is simply to buy life insurance. Life insurance is considered an intangible asset for a foreign national. So a foreign national could own a $50 million life insurance policy, die, and that $50 million will go to his or her beneficiary income tax free and estate tax free. As I mentioned, for foreign nationals, it's kind of an exception. It's considered an intangible asset, where real estate is considered a tangible asset. So, a U.S. citizen or a permanent resident They have this $12,060,000 exemption. A foreign national does not. And so any assets that a foreign national owns in the United States is going to be subject to a 40% estate tax, anything exceeding $60,000. Here's the IRS tax code regarding the fact that life insurance proceeds are excluded from a non-resident alien's estate. And as I mentioned, it's considered an intangible asset. Here's an example. A wealthy Chinese business person, female, age 50, currently living in Shanghai. Her child is attending college at Harvard. So she purchased a brownstone home for $3 million for the child to live in while at school. And she also owns an additional $9.5 million in real estate, which includes a nice vacation home in Malibu, California. The problem is this client now has $12.5 million of U.S. assets that is included in her taxable estate. And when she dies, that is going to be subject to a 40% estate tax. So if you have $12.5 million worth of real estate as a foreign national, you're going to have an estate tax liability of almost $5 million upon death. And the IRS wants that money in 9 months. And so a good solution to take care of that risk is to buy a life insurance, because the beneficiaries could certainly sell the real estate and use those proceeds to pay the tax, but it might be a bad time to sell real estate. And anyone that's going to be buying that real estate is probably going to know that the family needs to liquidate it to pay the estate tax, and you're not going to get top dollar on that transaction to sell that stuff. So better solution, why not just buy some life insurance? Here is an example of 4 different types of life insurance policies you could buy in the United States to cover this $5 million risk that this female 50 has. One option is simply to buy a term insurance policy. Term insurance, as the name implies, provides protection for a certain time frame. You have a 10-year term, a 15-year term, a 20-year term. 20-year term is the most popularly sold term insurance product in the country, and it's very cheap. And in this example, this female 50 could get a $5 million term policy for only $6,482 a year. Super cheap. The problem is you're unlikely to die in those first 20 years. If you qualified for the insurance, then in a term policy, your odds of dying in that 20 years are very small. And what happens after 20 years on a term policy? Well, look, the premium starts bumping up. It jumps up to $46,000. By the time you get to year 30, that term insurance premium has ballooned to over $350,000. So the only people that are going to keep a term policy after that term period are people that are very sick and about ready to die. So it doesn't make sense long term to buy a term policy. It gets very expensive down the road. The other option is to buy a permanent policy, and a permanent policy is usually something that provides cash value and death benefit. And this policy continues out. They actually illustrate policies out to age 120 these days. So here is what I call a level pay on a permanent insurance policy. Here's our premium. It's $42,325. You pay that premium every single year, and you have a $5 million death benefit. Goes out to age 120, and there is cash value. Not everyone wants to pay a premium every single year, so you can design these things any way you want. Here's what I call a 5-pay. So the client pays $162,000 years 1 through 5. You got a $5 million policy, goes out to age 120. And if you want to build more cash value, you can overfund these permanent life insurance policies so that you can build more cash values. Cash values can be used tax-free, and you also have the death benefit. So if you look at year 20, you have cash value on this level pay just over $1 million. On our 5-pay, cash value just over $1.5 million. But if we max fund this, we've increased our cash value to over $4.6 million. So these are just some designs that are typical of this life insurance space. And I wanted to show you how attractive these policies are as an asset class. What you're seeing here is at normal life expectancy, age 89 in this example. This is the pre-tax equivalent internal rate of return on the death benefit. So it's 7.86% on this permanent insurance product. So what that means is if this client contributed $42,325 every year for the next 40 years in a hypothetical taxable investment, what rate of return would you have to achieve before it would be worth $5 million? Well, it's 7.86% on this design, 8.16% on this design, and then 10.32% on this max funded design. And the reason the max funded design is higher is because there's so much cash in the policy, it started pushing up the death benefit. So these are attractive asset classes, and this is why many foreign nationals are coming to the United States to buy life insurance. With this particular non-resident alien, again, the female age 50, she decided to go with what's known as an index universal life product. Based on what I'm seeing in the marketplace, an index universal life product is far and away the most commonly used permanent life insurance product to solve long-term insurance needs. That's what most of the foreign nationals that I've been involved with are buying, index universal life. But there's many different options. I'm just telling you what is most common and what I'm seeing in the marketplace. Index universal life is complicated. It's an unusual and interesting type of life insurance product. So hopefully this chart will give you a little bit of an education on how this thing works. If you just assume that you contributed $100,000 to a traditional retirement account, let's just call it an S&P 500 mutual fund, an equity account, something in the stock market. You put in 100,000, the market goes up 10%, you got 110,000. Year two, the market drops 15%, so you're at 93,500. And then in year three, the market rebounds up 5%, so you're at 98,000 and some change. So that's a typical equity investment, one that you can lose principal in. By contrast, if you put the same $100,000 into what's called an index universal life product, market goes up 10%, you're at 110,000, but your gain is locked in. You're never going to lose that 110,000 because when the market drops 15% in year two, this account does not go down with it. You are contractually guaranteed to get a zero when the market drops, and you're simply waiting for the market to rebound in year three. You start from your ending point up 5% in this example, and you're at 115.5, which is a 17.6% advantage over a traditional equity investment, something that you can lose principal in. That's the sizzle on an index universal life product. You get the upside of an index like the S&P 500, but you're contractually guaranteed to never have a negative rate of return. This is a chart. I love this chart. This is the growth of $100,000 on the S&P 500 in red versus an index universal life index strategy with a 0 floor and a 12% cap. And what that means in English is your index universal life product, the crediting is going to be between 0 and 12%, depending on what the S&P 500 does. So this thing is going back to 1998 through June of this year, 2022. In red, again, is the S&P 500. We plug in $100,000. It goes up a little bit. We hit a 3-year bear market in 2000 through 2002. Goes back up. We hit another bear market in 2008. Goes back up. And then we hit another bear market that we're experiencing today. And over this 23-year time frame, your 100,000 grew to just over 334,000. By contrast, you put the same $100,000 into an index universal life product with a 12% cap and a 0 floor. We got some gains and some zeros and some 12s along the way, and this thing just keeps on plugging away. You're never taking a loss. And by the time we get out 23 years, our $100,000 grew to 493,000, a significant advantage or improvement over just the S&P 500. Why are foreign nationals buying life insurance inside the U.S.? As I mentioned before, it's often to cover that estate tax liability on real estate assets that are owned. But there are other reasons to come to the United States. First off, there's a lot more products, different types of life insurance products available in the United States. There are some countries that might only have 2 different types of life insurance products available, so they might be very limited. And there are a lot of different insurance carriers that are competing with each other for the business, coming out with new, exciting life insurance products and making them, more competitive each year. The U.S. is also a great place to buy these policies because of the U.S. currency. It's considered very stable. It's a recognizable currency. You don't have to worry about currency fluctuations as much as other types of currencies. And again, you're looking at a lot of different insurance carriers active in the foreign national space and being very competitive to get that business. BGA Insurance, we did business with over 64 different insurance carriers last year. We, strive to find the very best product and underwriting decision for the clients we work with. When you are thinking about buying a luxury car, you might be thinking about going to the United Kingdom or Germany. If you're trying to buy a great sports car, maybe you're thinking about an Italian car. If you're looking for good coffee, maybe you're thinking about Brazilian coffee. If you're looking for a good watch, maybe you're going to Switzerland to get that watch. Well, if it's life insurance, it's the United States. We have the best and most competitively priced life insurance products in the world, no question. There's not even a close second. So whether you're a permanent resident, a non-resident alien, or a U.S. citizen, the reason to buy life insurance, they're the same reasons. The personal needs would include income protection, income replacement. If you're making a lot of money, you're putting away a lot of money for retirement, and boom, you hop on the wrong plane. That's gone. Your family's not receiving that income that you were earning. Well, you need income replacement insurance. You're looking for survivor benefits, the kids, the family, estate tax planning, supplement retirement income, tax-free tax diversification. These are all reasons people are buying insurance in the United States. And of course, you have business needs, buy, sell, key person. If you have a business in the U.S., you need that type of protection typically. How safe are U.S. life insurance companies? Well, U.S. insurance carriers are highly regulated. They have capital reserve requirements that they're getting audited annually. You have regular state reviews. And basically, they have this thing called risk-based capital, that these insurance companies, their assets need to exceed their liabilities, their promises. And most of these insurance companies have a risk-based capital ratio somewhere between 350 and 450%, which means they have an extra 400% in assets over and above all the liabilities and promises that they've made. So these are highly capitalized companies. And we also have all these insurance companies are rated by independent rating companies, and this is all public information. So a lot of reviews and things are going on to make sure these companies are in good shape. So when the IRS is looking at someone that owns a life insurance policy or someone that they're looking to tax, they're trying to decide, are you a resident alien or are you a non-resident alien? And, what are the differences? What's the IRS looking at? Well, if you're a resident alien, that means your primary residence is probably in the United States. Your immediate family is often located in the U.S. Your personal and business assets are typically in the U.S., and you're typically paying taxes in the U.S. If you're a non-resident alien, typically your primary residence is outside the U.S. Your immediate family is outside the U.S. Personal and business assets also outside of the U.S. And then you're typically paying most of your taxes outside of the U.S. And so that's what the IRS is looking at when they're deciding how to tax you or your estate upon death. This is kind of a nice little cheat sheet, kind of telling you what kind of estate and gift tax rules that are in the United States based on whether you're a non-resident alien or a resident alien. As I mentioned before, a resident alien, you have a $12,060,000 estate exemption. So if your estate in the United States is less than that, you don't pay estate taxes. If it's over that, you will pay estate taxes on the amounts over that. But if you're a non-resident alien, your estate tax exemption is only $60,000. So if any assets you own in the United States north of $60,000 are going to be subject to an estate tax of 40%. So with life insurance, you need to qualify. Now, there is medical underwriting. So basically, your using your health to buy the life insurance, even though you're using dollars to pay the premium. You need to be somewhat healthy to get a policy in the United States. The medical requirements are typically an insurance exam. They're going to draw blood, urinalysis, ask you medical questions. And the other benefits, of course, of life insurance are the fact that it's self-completing. You got that death benefit. You have unique tax benefits. The money in the permanent life insurance policy grows tax-free. You have a tax-free death benefit, and of course, you can pull money out completely tax-free. Big, big benefit there. Right now, there are actually only 3 products in the United States that you can enjoy completely tax-free. You have municipal bonds. So right now, you might be lucky to get a yield of around 3% on a municipal bond, and that's not even going to beat inflation. The other option is you can put money in a Roth IRA. The downside on a Roth IRA is you can only contribute $6,000 a year. And if you make over $193,000 a year, you don't even qualify for a Roth IRA. The only other financial instrument in the United States that you can enjoy completely tax-free is cash value life insurance. And with cash value life insurance, there are no contribution limits, and it's available to anyone that is insurable. With any other investment that you put money in the United States, you are going to pay taxes on at some point in time. There's only 3 options. That's, again, why a lot of foreign nationals are coming to the United States and buying cash value life insurance. They know it's safe. They know it's going to be there. It's private, and they're diversifying outside of their main country. Now, historically, we are in a low tax environment in the United States. So right now, the top federal tax rate, income tax rate, is 37%. But historically, if you go back to when the tax code started in 1913, the average top tax bracket in this country is just north of 57%. So with any other type of retirement plan that you're putting money into, you're in essence rolling the dice to see what tax bracket you're going to be in 10, 15, 20 years down the road. And so what we're often recommending our clients is pay taxes now while we're in a low tax environment, put it into cash value life insurance. You'll never pay tax on that money again. This is an interesting slide. This slide was actually created prior to the pandemic. And what it's telling us is 92% of the U.S. tax revenue is being used to pay for 4 things. You have Medicare, Medicaid, Social Security, and the interest on the U.S. debt. I mean, this doesn't even include defense spending. And so, and this is showing, or the pandemic for that matter. And what this is showing in 2025, it's projected that 100% of the U.S. tax revenue is going to be used to pay for these 4 items: Medicare, Medicaid, Social Security, and the interest on the U.S. debt. Well, what's Congress going to do? What's going to happen? Well, they're going to reduce these benefits, or they're going to increase taxes, or, in my opinion, they're going to do both. So again, we're in a low tax environment. When you put money in cash value life insurance, you're using after-tax dollars. So pay taxes while we're in a low tax environment, put it into the policy. You'll never pay tax on that money again. This is just showing you the benefits of cash value life insurance. What you'll see if you compare cash value life insurance to a qualified plan, a tax-deferred product, or a taxable account, and a qualified plan would be like a 401k plan. We got a lot of checks on the cash value life insurance compared to these other options. So there's a lot of benefits owning cash value life insurance. First of all, the money grows tax deferred. There are certain states that provide a high level of creditor protection on personally owned life insurance policies. There are no contribution limits. You can put in as much as you want into cash value life insurance. There are no minimum distribution requirements at 70.5. No penalties for pulling money out prior to 59.5. You can pull the money out tax-free if you do it correctly. And if you structure the policy correctly, it can be free of income taxes and estate taxes. And of course, we have that tax-free death benefit. So a lot of benefits on the life insurance. Here's a design where our primary goal might be supplement retirement using a cash value life insurance policy. We got a female 50 preferred non-smoker, and she's going to contribute $360,000 a year. for 5 years into a index universal life policy, and we're assuming she takes distributions from the policy starting at age 65 throughout the rest of her life. And we're comparing this to other traditional retirement accounts. So this is a nice report that compares an index universal life policy to a tax-deductible retirement account, a tax-deferred account, I would just call that a variable annuity, and then a taxable account. That would be like a brokerage account or a mutual fund. And this report is taking real world taxes and management fees into account. And in this example, we're assuming that all these policies are growing at 6%. We have our cash value life insurance policy here. We got a $5 million death benefit, and we're contributing $360,000 a year for 5 years. And starting at age 65, we're pulling out our income that we can out of these policies, and it's $284,640. And what you'll see, these traditional policies, they start running out of money. In fact, our variable annuity runs out of money at age 74. One of the reasons for that is it's subject to income taxes when you pull the money out at retirement, and they have higher fees than many other products. Our taxable account, money runs out at age 77. Our hypothetical 401k plan is still alive, assuming you can actually put more than $360,000 into a 401k plan, which you can't. But even if you could, it's still running out of money at age 80. And where our cash value life insurance, we're continuing our tax-free income stream of $284,000 all the way to age 100. If you make it to age 100, your family still has a $2 million death benefit. And our total lifetime distributions is actually over $10.2 million you pulled out of this thing tax-free. Our next best option was a hypothetical 401k plan at just over $4.4 million. So it's not even close as compared to traditional retirement accounts when you take real world taxes and management fees into account. In fact, this page tells you the rate of return you have to get on traditional retirement accounts to compete with an index universal life product growing at 6%. So your taxable account, you got to get north of 10%. Your variable annuity or deferred account, you need to get north of 11%. And your hypothetical 401k plan, you need to get north of 8%. If you're not getting those numbers, you'd be better off with an index UL. And again, one of the reasons, if you want to pull out, if you want to net $284,000 for your lifestyle needs, and you're in a 401k plan or an annuity product, you're going to have to pull out $474 to net that $284, assuming you're in a 40% tax bracket. So another big advantage to the life insurance. This is just a summary of what we were just looking at. All these other traditional retirement plans are going to expire or run out of money somewhere between ages 74 and 80. Our life insurance continues on for life, and you're pulling out a lot more compared to your traditional options. So this kind of summarizes, the benefits of a permanent life insurance policy: tax-free accumulation, tax-free retirement income. The way we're beating the IRS when we're pulling the gains out of these life insurance policies is we're calling them a loan, and it's a loan you never have to repay back. These policies have what are referred to as preferred loans, where the insurance company might charge you 4% interest on the loan, but they will credit you 4% interest on the loan at the same time. So in essence, you have a zero spread, zero cost loan. Pretty good deal. The cash value can be used for any purchase that you want. No waiting periods. I mean, you can access that money whenever you want. And then there's some additional living benefits that are often added to these policies. You have what's referred to as chronic illness, critical illness riders, and long-term care riders. Some of these policies, those riders are actually baked into the policy, free chronic illness riders. So if you get hurt or sick along the way, you can access your death benefit tax-free. So some nice added perks that are available on U.S. domestic life insurance products. So just kind of want to summarize we've talked a lot about index universal life insurance products, but there are other insurance products out there. I'm just telling you what I'm seeing people are usually buying today, but there's a lot of different products, and depending on your needs and goals, that one of these other types of products might be of interest. I've mentioned term insurance. It's low cost. The problem with that is the term period expires and you're still alive. One other advantage with term insurance, and this varies by insurance carrier, they have convertible term insurance. So you might get a super preferred offer. You have a term policy 5 years down the road, you get cancer. You're going to survive the cancer, but you're never going to get that super preferred rate. You are allowed to convert to a permanent insurance policy at that super preferred underwriting class without any underwriting. So you might look at some conversion options if that is to occur to you. Whole life used to be the number one selling permanent insurance product out there in the marketplace. Now it's, there's still a lot of it sold. You have guaranteed cash value. The problem that I'm seeing with whole life is the fact, first off, it's expensive. If you want to buy a $5 million whole life policy and you compare that price to buying a $5 million policy on a index universal life product or a universal life product or a variable universal life product, the whole life's going to be somewhere between 25 to 40% more expensive. It's also inflexible. Often you have to pay premiums every single year for a certain period of time, and you can't skip those premiums or reduce those premiums. Dividend rates have been declining over the last 30 years, but we've seen an uptick in interest rates, so hopefully dividends will start to crank back up. Universal life was first established in 1983 when interest rates were very high. These were based on the insurance carrier's general account, the returns these insurance carriers were getting. They would pass on those returns to the clients on these universal life products. When they first rolled out, we were in very high interest rate environment. These universal life products were crediting 7, 8, 9, 10% interest back in the 80s. Interest rates have come down, so some of these policies didn't perform as they were originally projected. In the 1990s, variable universal life became very popular, and in essence, what a variable universal life policy is, in essence, a mutual fund surrounded with a life insurance wrapper to make all that cash value growth tax-free. And so, you get the most upside on a variable universal life product. Of course, the downside is bear markets. You can lose principal. And we had a 3-year bear market in 2000, another one in 2008, and another one that we're experiencing right now in 2022. So that's, there's pros and cons on everything out there. In my opinion, I think the insurance industry finally figured it out in the late 90s, early 2000 when they first rolled out index universal life. You get the upside of an index like the S&P 500, but you're contractually guaranteed to never have a negative rate of return. The worst return you can get is a zero. Zero is our hero. These products are transparent. They're flexible. You can modify your premiums. They're inexpensive. You get more upside than a traditional current assumption universal life. You have more guarantees and safety than a variable universal life product. So this is what I think people are gravitating to, and what I'm seeing most people buy. But again, no one size fits all. We hope to work with your goals and your risk tolerances and decide what is your best fit in product. And of course, we're always striving to find the very best underwriting decision out there. One thing I want to just address is the cost of waiting. Life insurance will never be as cheap as it is today, because every day you're 1 year closer to death, and it gets more expensive every single year. So it'll never be as cheap as it today. And here is a nice little chart an insurance carrier provided showing the cost of waiting. So when you get an insurance policy, there are different underwriting categories. You typically have a preferred best or super preferred underwriting category at the very top. Then you have a preferred rate, and then you have a standard rate. And then if you're somewhat unhealthy, they give you what's called a rating, where they increase the mortality costs in the policy. And then if the insurance carrier just doesn't like you, you're going to be postponed or outright declined. So of all the 60-year-olds that are with this insurance company, 35% of them get preferred or preferred best underwriting classifications, and 29% of them are rated, postponed, or declined. If you simply wait 5 years, you'll see that the ratio drops to only 22% of 65-year-olds are getting preferred or preferred best underwriting classes, and 45% of them are getting rated, postponed, or declined. So again, if you think you have a life insurance need, don't wait. It's going to cost you money if you wait. And here's a perfect example of that, where we have a gentleman, age 48, needs $5 million of death benefit protection. If he bought a policy today, it's going to cost him $43,396 a year. That's a level pay for life, and then your family gets a $5 million death benefit. If this guy waits 5 years until he's 53, look at that premium bump up. It's going to bump up to $68,040. So waiting 5 years, it increased that premium quite dramatically. And if this guy continues to pay that premium through life expectancy, age 88 in this example, if he would have bought it at age 48, he would have spent just over $1.7 million. If he waited 5 years and got that policy when he was 53, he's going to pay almost $2.5 million. What did it cost him to wait? $670,000. So that is the presentation. So we're going to open this thing up for questions. Hopefully, I went over a lot of material, and it's some of this stuff is quite complicated. So that's why we're going to open this thing up for questions.